What's going on, everybody? Today I want to shoot a quick video just talking about some portfolio illustrations and what someone might can expect from, allocating their portfolio to 100% SPY. So, if you're not familiar with what SPY is an ETF that tracks the S&P 500 index. It is a fund managed by Spider. The, that's the fund manager. I'm going to quickly run through some different portfolio sizes ranging from 1,000 to a million. Some data over here. This is the dividend history, just the last 20, 30 years, NASDAQ.com. Just want to definitely go check them out if you're looking for some historical data. Here's some current data for SPY. It's currently trading at right around 398.95. Year to date, the whole market's been, definitely red year to date, down 16%. Its average return over the 3, 5, and 10-year time horizon is 8.28%, 8.5, and 10.9. This data, I pulled it from a website. I'll link it down below. But this is after, tax distributions and capital gain tax. So there is going to be some buys and sells that they do throughout the year with this ETF. Next one is the dividend stats. Currently it's paying around $6.18 per share. This is gonna, obviously fluctuate because this is just a basket of 500 stocks. Its dividend yield is right on 1.57%. Dividend growth has been 4.04%, 5.26%, and 8.08%. And then this is a link to our website that just helps you calculate. So, for example, say you have 16 shares and you don't want to do the calculation yourself, you can quickly plug it into this calculator and it'll spit out an estimated, annual and quarterly income that you can expect. So let's go ahead and jump into it here. Some different columns, obviously the shares. This is going to just calculate based on the current price, how many shares you can buy, what's your estimated dividends, annual dividends, and then whether or not you can sell covered calls. Just in order to sell a covered call, you have to have 100 shares. So it is going to take us a little while to get there. So let's go ahead and look at this column here. Change to black. Investing $1,000 into SPY at current market prices, you're going to get around 2.51 shares and right at $15.48 in dividends. $2,000 is going to double that, right around 5 shares, double your dividends at 30.96. Same with 4,000, you're just pretty much doubling your portfolio size here. 8,000, same thing. 15,000, you cross that $200 mark in annual dividends. 37 shares. We're getting closer to the ability to sell one covered call per week. Almost approaching $400 dividends, $400 in annual dividends, right around $25,000. And then $50,000 invested, you're going to get approximately 125 shares, which then you can start leveraging and selling weekly covered calls. Actually, SPY actually has 3 expirations per week, so you could essentially sell 3 covered calls per week. Moving on to 100,000, 250 shares, cross that $1,000 mark in dividends. $1,548. 250. Almost $4,000 in annual dividends. 600 shares. That means you can sell 6 covered calls per week. Pretty nice. $500,000 just scaling up here. 1,253 shares. Almost $8,000 in annual dividends. And you can now sell 12 covered calls per week. And lastly, for this illustration, if you had $1 million invested into SPY, it's going to give you approximately 2,500 shares, 2,506, around $16,000 in dividends, and then the ability to sell 25 covered calls. So, depending on how like aggressive you are with your covered calls, obviously your income is going to be much higher. So a lot of people aren't attractive to SPY because it has a 1.57% dividend, which is understandable. But why I like it is obviously the growth. It's a very passive way to invest and to get, stock market average returns, 8, 9, 10%. And then the dividend growth is good too. That's something that I like. I like to buy something that is going to continually increase its dividend, year after year. That's definitely a big part of my strategy. And then the ability to sell covered calls. I think there's a lot of opportunity with covered calls, even more so than the dividend. Obviously doubling this I think would be very, very conservative. You could easily get this closer to like a 3 or 4% dividend yield pretty easily, I would say. Depending on the size of your portfolio, obviously, scaling can be difficult, but I think it's very, very attainable. Now, obviously, you're gonna have to know how to sell covered calls, and how to manage them correctly. But there's tons of opportunities out there. SPY now offers 3 expirations per week, which is really good. Monday, Wednesday, Friday. Or you can sell, once a month if you don't want to be as active with the 3 times a week. You can sell, once a month, 30 days out. Or you can sell one per year if you essentially want to. If you come January 1st and you want to sell a covered call all the way out till December, you can take a calculated guess and say, hey, I don't think SPY is going to increase by more than 30% this year. So you can go 30% out of the money and sell a covered call. That's always an option too. But yeah, there's just so many different opportunities with covered calls. That's why I think, that's why a lot of people like SPY over VOO. VOO is another popular one. Its expense ratio is a little bit cheaper. I think it's 0.03 and SPY is like 0.09. So you're going to pay more expenses and fund management fees, but the volume in SPY is so much more than VOO. So, if you don't even want to mess with selling covered calls, VOO could be a better option for you, obviously. It's cheaper. You're not going to actively be trading covered calls or anything like that. And, maybe that's an option too if you want to maybe just passively buy VOO, but then you could sell, sell like puts on SPY. Like that's an option too. There's so many different strategies out there. I just really wanted to illustrate kind of this portfolio right here. If you invested 100% into SPY and then you sold covered calls. Now, I could go a little bit deeper as far as like assuming like if you collected an additional 4% in income, how much? I can quickly do that here. So let's see. Let's add a column. So let's add one right here. Just assuming this one covered call, if you collected 1%, how do we want to do this? Let's just say you sold 4 covered calls a year and you collected 0.25%. So you increased your yield by an additional 1%. So this would be 2.57%. So 0.01 times So let's actually think about this. So it would really be close to 40,000. So 1% on 40,000 because you could sell one covered call. So that's an additional $400. So here it's going to be times 2 because you could do 80,000. $400 times 6. Thinking that's right. 400 times 12, and 400 times 25. So you can see here, you just increased your income significantly. Obviously, it's not, you didn't double the yield, but all you had to do is add 1% more. So now let's see what we're actually yielding. So it's going to be 2.57%. So yeah, so this is just hypothetically speaking, if you collected an additional 1% in covered calls on the overall portfolio. So this is assuming you were able to sell one covered call and collect 1% a year. So you're going to collect $400 from that and so on. So that's it for this video, guys. I just wanted to quickly show kind of some illustrations that you can create here. Obviously, do your own research, understand the risk of options. But this is just a cool little illustrative video I wanted to put together to show you guys all the types of possibilities that you can do with SPY and options, and the combination of options and dividends is very beneficial. So that's it for the video. If you stuck around this long, appreciate it. Please subscribe, like, comment down below.